You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by SWAN Global Investments. Since 1997, SWAN has been the leader in hedged equity and option income strategies with GIPS verified results. SWAN provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, SWAN Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think SWAN when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music can mean only one thing. It is time for the Advisor's Option, our final episode here for this insane year that was 2020. Going to have a fun time looking back at all that madness today on the show. My name, of course, Mark Longo from theoptionsinsider.com, as well as, of course, from this network upon which so many of you have been binging throughout the year. Let me take a special moment, A, to thank everyone who's listened throughout the year, and then B, the mad influx of new folks who have joined the network and have picked up on the Advisor's Option throughout the course of the maelstrom that was 2020. Welcome to you all. I don't care how you get it, whether you're after the fact on the legion of platforms out there, your Apple Podcasts, your Google Podcasts, our app. Remember, if you listen by all those on-demand platforms, be sure to keep leaving those reviews and those ratings on those platforms. It does help new people continue to discover the content. Also, welcome to all you folks who listen live and send in your questions and your comments. We love to hear from you, however you guys like to reach out. And of course, going to hear from a lot of you today on the show a little bit later. And let's see who else we're hearing from on the old program. And wouldn't it be an episode of the Advisor's Option in the dumpster fire year that was 2020 without my two steadfast cohorts, my compatriots, my partners in crime. First, let's go out to the far northern hinterlands of New Hampshire, where we are joined once again by the Oracle of New Hampshire himself, a epithet, a nom de trading that he earned on this very program earlier this year, none other than Mr. Matt Amberson, the founder over there at ORATS, a.k.a. Options Research and Technology Services. Mr. Matt, a.k.a. the Sharp Dressed Man as well, welcome back to the Advisor's Option. One more time for 2020, sir.
Thanks, Mark. These shows go quickly, and this year has gone quickly. I don't know.
I suppose. I guess in one frame of reference, it has flown by. In the other frame of reference, it has been just watching the sands trickle through the hourglass. We'll see when we get back to it a little bit. We start off at the beginning of the year. It's how some of this seems like it was 20 years ago. But we'll get there. First, we got to dial that hand of the clock all the way down now to a quiet, tranquil, and indeed tropical island out there in the Atlantic, a.k.a. Puerto Rico. We're joined once again by the Director of Risk himself, Mr. Chris Hausman, the Portfolio Manager and indeed Managing Director of Risk over there at SWAN Global Investments. Mr. Risk Director, welcome back to the Advisor's Option one more time for 2020, sir.
Yep, guys, good to be on one last time here in 2020, and I agree, it's been I don't know if this has ever happened, right? It's been the quickest and the longest year at the same time.
It has indeed been that. Going to be a good episode to sink our teeth into. So without further ado, let's kick it off.
Busy financial advisors and asset managers don't have time to follow the latest developments from the world of options. So we do it for you. It's time to get the buzz.
All right, everybody. It is time. It is time to look back on the madness, the maelstrom, just the chaos and carnage that have been the year of 2020. And the Advisor's Option is a program that is uniquely situated to do this because a lot of our other shows pop off once a week, twice a week, something else like that. This show comes in once a month, so it gives you a nice snapshot, a nice ready frame of reference for how this year has evolved and indeed how the markets and how volatility and everything else have evolved throughout the course of this year. So let's kick it off. Let's dive right in and start at the top and kind of work our way through just the madness that has been this show and the madness that has been the markets over the year of 2020. So let's kick it off. Let's go back to our first episodes. Dial your own mental wayback machines, if you will, listeners. All the way back to the heady days of January 28th of this year. Oh, it seems how tranquil, how far away that may have been. That was our first episode of the year. We like to do them towards the end of the month because it gives us a chance to encapsulate what's going on for the entire month there in one episode. At that time, coming into that showtime, VIX was at about 16.25. You may look back and say, wow, that seems kind of high. But then once you start thinking about everything that was going on back then, you may look back in hindsight and say, oh, that's actually surprisingly, perhaps even shockingly low. What was going on? Back then, everyone thinks of the period maybe in January before February really as this quiet period of the year, but a lot was actually unfolding back then. Of course, the year kicked off with a literal bang. January 3rd, we had the assassination of the Iranian general Soleimani over there, so that really kicked everything off with a huge bang out there. People were worried about a little bit of Middle East tension, a little bit of Middle East flare-up over there. Of course, does anyone even remember the impeachment at this point? It seems like such a distant memory, but we were in the midst of that as well on January 28th. It was kind of like right in the teeth of it, actually, because the vote didn't happen until about a week or so later on February 5th. So we were kind of in the final stages of that. So already we had kicked off potentially an armed conflict in the Middle East, and we were potentially facing, it didn't seem likely, but potentially facing the removal of a sitting president in the U.S. And then, of course, we were still on the tail end, in the middle of, really, it hasn't really ended, the trade war with China. Add all that into the mix, 16 and a quarter might actually look a little bit cheap. And then, of course, as we were recording the show, we were just coming off the first systemic shocks of what would become this mad pandemic market that we've all lived through. We had our first real big sell-off. The Dow had plunged over 400 points. Everyone likes to quote the Dow. It's just a big point total one, so that gets thrown into the top of the headlines of all the articles. This one came from USA Today. As they said, fears about coronavirus rattle investors. Think about this in the snapshot as well. The death toll in China had climbed to 81, and 100 people in the U.S. were being monitored for the virus. Think about that frame of reference. And that was enough to spook the markets the way it was. Now, if I had told you, given that scant amount of information, and fast forward to the end of the year, 300+ thousand dead in America, 100+ thousand hospitalized as we speak, large swaths of the economy shut down, and we'd be all the way back to where we were, and if indeed beyond, you'd have said I was a madman. But c'est la vie, where we find ourselves. Also, a good buddy, Mr. Randy Swan, was quoted in this article in USA Today saying, right now we're still in a speculative phase with regard to handicapping how much the virus will ultimately impact the global economy or even corporate profits in travel-linked sectors, Randy said out there. So a lot was going on out there. That's kind of the table setting for our first episode of the year. Mr. Director of Risk, we'll start with you looking back. Hey, what are your thoughts on just these kind of now anemic numbers, 100 people in the U.S., 81 people in China? That was enough to send us into a tailspin, and how all that looks in hindsight, sir.
Yeah, I mean, those numbers are both crazy and tragic at the same time. I'll be honest, I think going back in January, nobody was really worried about this potential pandemic that was about to occur. It was being discounted like a swine flu or something else. And the reality with the marketplace is it's like volatility. When something happens with volatility, you need something bigger and stronger to get markets spooked out. And it's kind of like, you mentioned some political events here. I don't think political events are having the impact on the market they once did. I don't think hurricanes and storms and earthquakes are having the impact on the market like they once did. And I don't want to fast forward on the show too much because I'm sure we'll talk about what's impacting the market over the next few minutes. But yeah, it's. I think at the start of this, everyone was kind of like, ho hum, let's see what happens. But there wasn't that much concern just yet in January.
Matt, same thoughts for you. This is also where we started to maybe see that turning point in volatility. I believe this was the episode where you kind of earned your moniker of the Oracle of New Hampshire, because we had been talking for a while. When would that worm turn? When would we see the inflection point for a higher level of vol? And you said back then, I do believe, that you thought this was it. This new regime of volatility was for real, sir.
Yeah, I think I was about a half a month too quick. I'm looking back at my calendar. I remember after this show, I went to the Reuters meeting in New York and called that the market was going to be down at least 10%. The Chinese are lying about it. It's going to be bigger than we thought. They didn't print it, of course, because they're Reuters, and no one was printing anything at that point. But I remember seeing some numbers coming out. I don't look at the regular news stations. I look at some of these offbeat news and scientists, and they were already kind of panicking a little bit. And I started to panic or get worried about the pandemic at the end of January. I remember just getting back from Nashville, which is in the news again, but and thinking that we're not going to be able to travel that much, and I'm glad we're able to get to New York and meet some of the clients, and then the market just drifted higher. I thought I was crazy, and then finally, it took half a month longer, and then we all know what happened. Not 10%, more like 30% down, and the crazy thing to me is the comeback since then, but that'll be a future month, Mark.
Oh, that story will come, sir. give us some time. We'll get there. A few other things did happen back in January that we talked about on the show that were relevant for the options-oriented audience. It doesn't seem like it was this year, but CME did launch Bitcoin options finally this year, and they kind of came out of the gate with a bit of a whimper. They did 54 contracts on their first day, despite the same day over 13,000 futures traded. So the futures are still pretty active. And fast forward to the end of the year, they're doing a little bit more paper now. It's still not blowing the doors off. In fact, the numbers from this week we just profiled on our crypto rundown program, about 350 on Monday and about 400 on Wednesday. Those are the two big days of the week. Remember, that's a 5x contract, so you have to factor in a multiplier there. But still, You're talking, I guess if you add in those, you're not quite 10x, but they're getting up there a little bit in terms of volume. Again, it's no Apple or Tesla yet, but it's doing a little bit more paper, and now they've announced Ether futures coming as well, so hopefully that will continue to grow the crypto complex over there. I know a lot of advisors, particularly right now, we'll get to it in a little bit, looking at Bitcoin threatening 30,000, thinking maybe I want to dip in those waters. Also, this was the month where we saw a judge finally dismissing, I think, the last of the lawsuits out there around VIX. Remember, there had been all these swirling allegations for several years, actually, about the VIX was being manipulated by folks at the SIBO, and we had talked about this many times. You all here on the show said that was kind of absurd. Maybe the VIX had flaws in its calculation, and that certainly could be an argument people could make, but the notion that they were down there in the basement of the SIBO with this lever kind of manipulating VIX hither and yon was kind of absurd, and the judge on this case said effectively the same thing. And on that episode, we also talked about some back-of-the-pocket strategies you should have in your back pocket as an advisor when clients come to you, ask about options. Talked about covered calls, far out of the money covered calls, match stress. He likes those better than closer to the money, as well as protective puts and ratio 1x2s and a whole bunch of other fun stuff. All right, that was January. Now fast forward to February. We recorded our episode in February on February 26th, also a faithful day. Back in February, right around February 20th was where the worm really started to turn to the dark side there. So coming on this show, we were about not even a week beyond that, and we were talking about just what a crazy day/week it was. All of us have been around the options market for a long time, and this was something else, and we were about to see even more, of course, on the next episode. On that time, VIX had now topped out at around 29.5, so almost double what it was on our previous episode. We saw spikes, similar levels. VXX, which is the product you guys love to fade, is back below this now, but it had spiked back up to 19.5. So we were starting to see the percolating of vol into the marketplace, some of the jitters coming in from the pandemic, and of course the first waves of sell-offs there as a result of all this madness. Matt or Mr. Director of Risk, anything to add on February? You guys want to just dive into the teeth of it in March?
No, I'll add something in February. Because a lot of people's models, February, if you recall, the show on 220 was about the low, and then it came back. So people thought that was the dip, and lo and behold, it goes about 2x lower. But I mean, some models came in as buyers then, and those people got hurt. And I remember, I always have these long way out of the money puts. And, the rules that we had as market makers is, take 20% immediately and then take about 40% of your profits later on and then deal with the rest. But, so the people that took 100% off of that little dip right there, were kicking themselves when the market went down another 2 times the mark. I think that's the important thing about that time.
People forget about that, obviously, in hindsight. We had a lot of people even on this network coming in, and certainly people writing in who had been following that old BTFD type mantra, which had worked out pretty well for the better part of the last decade until February. If you bought it in February going into March, you got hurt pretty badly. And some people, unfortunately, got margin calls and they weren't able to participate on the return to the upside there. So that is a good point, Matt. It's kind of a forgotten bit of impact in all this madness was all the folks who were really kind of chewing their fingernails going into March saying, oh, my God, what's going on? I've been buying this. And now we're just seeing mad sell-offs continue. So, yeah, BTFD doesn't always work out, let's just say. Then you got to be pretty judicious when you're out there doing all the folks on platforms like StockTwits and others. That's kind of their mantra. They have shirts about that. But, yeah, be judicious when you're doing that out there. Let's head on out now to the month that I don't think any of us will forget anytime soon. It was March of this year. We recorded our Advisors episode on March 25th of that year. I think just by any definition, this was an unprecedented, historic, chaotic, insane month. Pick your adjective, throw it in there. It probably applies. VIX coming into our show that day was at about a 64. So that just shows you a little bit of the trajectory of vol. 16, our first episode. 30 odd, let's see, what was it, our second episode there? 29.5, almost to 30, our second episode. And then 60, almost 64 on our third episode. So quite a trajectory in the first half of the year. Of course, that was the worst week at that time since 2008 for all the major indices. In the 8 sessions leading into our show, this market had risen or fallen by at least 4.8% in every one of them, nearly 5% swings every day. You had to go back to the Great Depression to find something even remotely analogous, remotely similar. The past 8 sessions leading up to our show, level 1 circuit breakers triggered 4 times, halting the market for 15 minutes. At the time, the S&P was then below the Christmas Eve 2018 lows. Remember, back in 2018, the end of the year was a pretty aggressive sell-off. So now back in March, we had sold off beyond that. So interesting stuff here. And of course, something we had talked about, theorized was, theoretically possible all the time back when we were on the trading floor, but didn't think we would actually see for quite some time. We saw it happen this year, the year we all dreaded as floor-based market makers. The entire options industry, 100% electronic for the first time. So you're talking CBOE, Amex, Picos, all those floors, all shut down. CME here across the street on the futures option side. The first time ever been done. 100% electronic. No one, myself included, I was a little bit skeptical about the chances of the industry being able to proceed without massive outages and massive failures. And lo and behold, it has held up fairly well, which is surprising. I mean, talking historic pit products, SPX, Eurodollars, things that had never even been considered really as a fully electronic product are now thrust into that spotlight for the first time. You also saw, just in general, historic vol levels intraday, VIX setting a new all-time closing high at the time of almost 83, 82, 69. This was also when Fed announced what were effectively unlimited asset purchases. That previous limit was somewhere around $700 billion. Other parts of the Fed, like the St. Louis Fed, were hypothesizing about 30% unemployment rates out there. We saw massive long-term storied market makers like Ronin in the option space go in the way of the dodo. People were very concerned about liquidity. Our buddy, the Flow Master, was writing about it. I know, Matt, that was an ongoing discussion topic by you as well. We saw the first, and until really now, only stimulus package from the government. It was a $2 trillion stimulus. By comparison, the New Deal, around $800 billion. So there was a big deal, this stimulus. And then, of course, everyone talks about the sell-offs in March. But then at that time, we got what we termed then on the show the mother of all rallies. That Tuesday leading into the show, the 10th best day for the S&P and the 4th best day for the Dow ever in history. It was the second 9+%, easy for me to say, rally just that month alone. So just insanity. Let's go around the horn. We could probably spend the whole show just on this month. We'll start with you, the director of risk, the massive sell-offs, the huge explosion in volatility, and then the turnaround, the massive turnaround. Just walk us through your thoughts at this time. What was going on? The challenges of managing the DRS and like a hedge portfolio during this time. What was lighting up your tape back then, sir?
Yeah, I think we do that show at the end of the year where we make our predictions, and I think I remember saying that something very unknown was going to happen in 2020, and the SPX was going to test at least 2,700. So the selling really started, right in the beginning of March when we broke that 3,000 level in the SPX, and obviously I didn't think we'd go lower than 27 when I made that prediction, but the unknown happened, and we went much further. So the good news about the DRS is that it's a hedged product, so that was the positive. But I'll admit, with the income trades, it was a very challenging period, and anybody who was short puts or any type of short volatility strategy was stressed out or challenged, to say the least. So I think that was the biggest thing. Is this was another one of those separators, like maybe February 2018 was, that those short volatility products, you managed your risk and you survived, or you were out of the game. And I think that the DRS did pull through, showing that it was hedging on the way down, on the downside, in addition to the challenges that we had managing those income trades.
I think this was the episode where you also had, the previous episode earlier this year, Matt had his infamous prognostication on VIX. I think this is where we were talking about whether there would be a comeback, a rally on this. And you said at the time something along the lines of, if we do have a recovery, it will be the mother of all V-shaped recoveries. And lo and behold, Mr. Director of Risk, that's exactly what we got, sir.
Yes, I didn't think it was going to happen. I don't know too many people who thought it was going to happen. And it goes back to what you said earlier here. It was just unprecedented support from central banks here, which to the likes that we've never seen in history. And I did not predict that. I don't know how many people would have thought that the printing press was going to go 36 hours a day nonstop, but it did, and we got that V-shaped recovery.
Mr. Matt, same question for you. I think we could probably spend many hours, and I'm sure there will be many treatises, many case studies, many academic studies, practical studies done on this month for years to come. But let's summarize it in a few minutes here. All of this madness, sir, what were you thinking? What was going on? What was lighting up your tape back in this maelstrom that was March, sir?
Well, what I doubled down on my triggers and my signals because I was trying to guess a bottom and all that, but the signals started to get positive not till the end of March, and until then, contango and these flat and forward volatility and the slope of the implied volatility, a lot of the things that I look at were so negative. And so trust the triggers that got you there was one of the lessons that I learned. And then just back to what you were talking about before, the electronification of trading, and some of the things I wrote at the time, the widths of the market, it got so out of whack, especially in the small stocks, which is something that we predicted on this show. Because what's happening is you have so few market makers, and they don't really pay attention because they don't make much money on the smaller stocks. Whereas when we were on the floor, we concentrated and we, could eke out a living on trading a bunch of small stocks. Now, these markets got at the peak of it, if you can imagine, 43 vol points wide. So you're 100 at 143 ball for some of these markets, which is crazy. And so that's what we were talking about and showing at the peak of it. The markets just widened out so much you couldn't get out of a lot of your positions that you were in. It was pretty chaotic, and I think the industry needs to learn from that. And that's one of the big things is they need to figure out a way to get more market maker or more eyes on those small products, because a lot of retail were very angry, and the markets can you imagine a Robinhood back then, like paying offers and selling, but you just give up so much money. So those are the big things that I take from this, Mark.
I'm sure that was probably a big chunk of that $65 million that Robinhood just paid in horrible executions. Probably a good chunk came during this mad period. Speaking of retail and what they thought, we polled our audience out there during this time. We kind of wanted to get your thoughts on this recovery. Did you think that rally we saw at the end of March had legs, or was it the world's biggest dead cat bounce? Quite simply, we asked you, would we be north of 2,400 in the S&P at the end of the week? Only 16.9% of you said yes. 73.2% of you said it was a dead cat bounce, and we were headed in the other direction. So our audience has pretty much been fading this rally for almost the entire time. But that said, there were some of you who were starting to eke out a little bit. We waited. That poll came a little bit later. Earlier in the month, we asked you, once we started turning around, we said, what are you guys doing? Are you short and riding this market down? Are you starting to nibble at long positions? Are you sitting in cash till it blows over or other? A little bit over half, 53.9% of you said you were starting to nibble at long positions back on March 18th. So even though you guys have mostly been fading it, that one poll perhaps maybe saying that that you guys hopefully had a good rest of the year. By the way, this was actually a month where the last time I or pretty much anyone in the industry went to a conference. I went to RMC. I saw people. I sat down with John Cherry and other people live and in person. Oh, how insane that seems now. But that was earlier that month, right around March 3rd or so, the CBOE Risk Management Conference. The conference the following week, FIA Boca, that was canceled. Of course, OIC, which was coming up in Puerto Rico, that was canceled. A lot of everything else obviously was canceled. So crazy time. And also just shows how insane March was. We were actually talking about long straddles, actually buying straddles in our Options 101. And you know what? It didn't matter what straddle you bought out there. They all worked for that insane time. There was that much vol, that much movement. That's how insane thing. We never talk about long straddles in a positive light here on the network, but that month we did. And a lot of you guys were asking questions about what happens to my options if the exchange is halted or shut down when I own puts in particular. So we answered a lot of questions about that at that time frame. All right, fast forward to April. Now about a month later, April 28th, another historic month for the markets. The markets are on their way back to an aggressive V-shaped recovery. Again, you guys got it right with your nibbling at long positions, even though a lot of you had also faded it and said it was a dead cat bounce. So kind of a little bit of both in our polls out there. VIX had retreated quite a bit off of its highs from previous shows here. And we also saw a stunner out there in April. That was back in April. It seems like it was even longer ago. Crude oil went negative, something we had theoretically considered was possible in any sort of commodity that has to be stored and delivered. It has that possibility. But no one had ever seen it or really anticipated it happening in real life. Yet, in the year that was 2020, we saw that happen. WTI went negative. I can't lost track on people I have contacted us and have been part of our network who are very knowledgeable in the space. We're thinking about loading up on those futures when they were down around a couple of cents because they all thought, what's the worst that could happen? We all learned what could happen. It could go many handles in your face to the negative territory. So, yeah, kind of a bit of a rude awakening for everyone. The Fed was actually talking about rates going negative at that time as well. And Mr. Matt, you were talking a lot about the impact, kind of you're just talking about, the impact on liquidity providers. You had done a lot of research and analysis about the bid and ask spreads in the S&P. And Chris, you guys over there at SWAN were also cranking out a lot of analysis, including your Markets in Crisis coronavirus outbreak white paper and all the analysis going up out there. We also crunched the numbers for March. No surprise, it was the highest month ever up to that point in the history of the options market. 670.6 million contracts, up about 63% from the year before, and a number that we would all pretty much see blown away pretty soon throughout the rest of the year. And of course, that was also the year in April where we all missed a trip down to have cigars with the director of risk in Puerto Rico. Oh, we were all sad about that. Let's start with the director of risk. Aside from daubing your tears, sir, the fact that we didn't have our scheduled OIC in sunny Puerto Rico, you guys put out a great paper about all of this, and this was still a tumultuous time, and we were still in rally-ho mode to the upside, even though it wasn't all whistling past the graveyard yet. What are your thoughts on what was going on out there in April, sir?
Well, it's still a crazy time. I don't think people really believed the all clear had been signaled, especially with the rally. I mean, we didn't get our signals really until the end of April. So, I mean, we missed that good chunk as far as, believing that things had changed and that the rally was here to stay. So, which, the stat you showed earlier with the poll, the majority thought we'd still be below 2,400, and I think we were definitely part of that majority at the time. So, as far as it was unfortunate that we canceled some of these conferences, those are always great times to catch up with a lot of people in the industry. But, we did listen as far as SWAN was concerned with the ETFs and the change that was happening in the marketplace. And, as a result, we did launch our own ETF. We launched the SWAN Hedged Equity U.S. Large Cap ETF. And that ticker is HEGD. So this is more along the lines of our traditional DRS products. It does not short puts for income on the downside, but has additional upside beta kicker for enhanced upside capture. So it still provides that downside protection. And that's a separating feature from a lot of these other buffer style type products. So, we were doing our homework and seeing how the industry has been changing slowly, from mutual fund model to lower cost ETF products that can still provide downside protection and enhance upside capture.
Well said, sir. Mr. Matt, same question for you, sir. Obviously, the madness of April, the vol wasn't behind us. VIX was about 33.5 still, so about half of its peak in March, but still double what it was there in January. Of course, you were analyzing a lot about liquidity out there, Mr. Matt, so that was obviously a concern of yours, which still resonates right now. What are your thoughts out there on everything we saw in the madness that was April, sir?
Well, the weirdest thing in April was undoubtedly the WTI going negative. I was looking for swimming pools in Cushing, Oklahoma to put the oil in, but unfortunately I couldn't get anything done there. And volatility was coming down. I agree with Chris. My signals still showed extremely high volatility. Contango was still there, meaning the front months were still way above the back months. So I didn't get the all clear, until things kind of flattened out and around mid-May. So that's when there was still so much uncertainty, and it was so hard to get the facts about what's going on and what the impact is going to be and how much it was almost like the new Fed came in they were just printing so much, and it was like it made your head spin. You couldn't even process the numbers. Like the graphs were just going exponential on the amount of balance sheet expansion. And it was really difficult, and I think it's still difficult for investors to get their head around what's really going on out there, Mark.
That it is. We also discussed a paper on that show submitted by our buddy Mr. Cott over there, analyzing our puts really efficient at protecting you from downside risk. We had a nice back and forth on that. And then we talked about in our Options 101 on that episode, short puts and put spreads. Vol was still obviously juicy. A lot of you were looking at ways to harvest premium, so we talked about some ways you could do that. And speaking of our savvy audience out there, we also asked you, in light of the negative crude oil debacle, what do you think is going to happen to USO? Is USO going to follow in the footsteps of other Franken products like XIV and kind of join the dustbin of history, or would it survive? And it was close, but about a little over half, 54.8% of you said yes, it would survive until the end of the year, and lo and behold, it is still here. USO, of course, a very different product now than it was back in April. And some may argue it's a better, some may argue it's a worse, but it's a different product right now. But either way, it has survived in this current incarnation all the way through, at least till today, unless it blows out today. So far, at least, it is still going. Back to May now, episode 5 of the year. VIX still frothy at about a 2760. And at that time, the markets were already almost back to their pre-corona levels. At the same time, though, people were still talking about this rally. Didn't really make a lot of sense. We've said it before throughout the year. This is probably the most faded rally in the history of mankind. I didn't talk to a single person, really, who was a professional in some capacity in the options or financial derivatives markets that really had a lot of faith in this rally. And yet, here we are on the tail end of this massive rally. At the time, they were pointing out the divergence in consumer sentiment versus stock valuations was at the highest level it had pretty much been in over a decade. And the spread, they termed it between the monthly percentage change, I should say, of the S&P versus the consumer sentiment survey out of University of Michigan was at an all-time high of 32 points, showing kind of a bit of a divergence between the markets and reality. April numbers were just in. Of course, April was up 42, almost 43%. Not quite beating March, but still a strong month out there in terms of options volume. The folks at SWAN were talking about how to retain clients for advisors during a crisis, a very important topic. And we also asked our audience, again, still on that tip of, are you guys buying this rally? Are you fading it? We did it through the lens of the VIX this time. We just said back on May 18th, VIX just broke through 30 for the first time to the downside. And since the pandemic really kicked off, we asked you, does this mark the beginning of the end of this era of volatility, or is it just setting the stage for the next move higher? And pretty much all of you, we asked you, where would VIX or spikes close a month from now? 45.8% said higher, north of 35. We said lower, less than 25, 19%. Around that level, 25 to 35 was 26.7%. And I'm in cash, I don't care, 8.5% out there. So a lot of you actually were still fading this rally, and we're looking for a little bit of downside movement out there. Let's go back to the director of risk. Chris, you guys were talking, an interesting talking point for advisors out there in the midst of all this madness about how they can retain clients, and also a talking point I know you've mentioned many times on the show throughout the year, kind of how this was the most faded rally in history, yet here we are. Mad times. So what are your thoughts about your research there from May, as well as what was going on over there and lighting up your tape back on the May episode, sir?
Yeah, I think the most important thing with clients is, especially when you're going through these types of times, is redefine your goals. There's a reason advisors exist. We've been doing this for a long time. We've been through similar events. None of the events are exactly the same, right? But we've been through similar events. And the ones that survive are the ones that can kind of make those transitions and take the data and analyze it and say, wait a minute, this may not be exactly the same, but has similarities. And especially if you're in strategies that are invested and are hedged, you can wait these times out when most people are panicking and running for the only exit door, in a movie theater that's on fire. You can sit back and say, well, wait a minute, what are my goals? What do I have on? What are my positions? Is this really, is my personal movie theater on fire? And usually the case is it's not. If anything, it provides opportunity, like Matt has mentioned, this year actually was a good trading year, believe it or not. There were a lot of opportunities here. If you managed your risk and you weren't shaken out and you had good signals, they weren't perfect. Because again, some new things happened that a lot of people hadn't seen in a very, very long time, or had never seen before. So again, it's always going back to that original plan having the ability to tweak that if necessary when you are under fire, and then managing that risk appropriately.
Mr. Matt, same question for you, sir. Dial your Wayback Machine in your brain back to the heady days of May, sir. What was lighting up your tape on this episode?
Well, I think what May taught a lot of people is, have your plan, reassess it if you need to, but you have developed a plan over a number of years. If we would have, kept with some of the selling put spreads, the 1x2s and such, to get back into it when you start to see the market settling. But it's hard to say the market settled too much, because still in May, that was as high as a volatility as we've seen. It was even higher than the peak that was reached in 2018. So it was still way up there. So, it was a very interesting trading environment. Personally, I for the reasons that I mentioned earlier, I went more into like gold and even some Bitcoin. And the gold and silver. Silver was hit 11, and Bitcoin hit 4,000. Like in the big panic. And so I didn't know what was going to happen to equities, but I knew that if they're printing that much, the golds, the Bitcoins, the silvers are going to do well. So, of course, I wish I would have been more into the market. I had a little bit, but, I went more into the commodities, and it worked out. But that rally, I was not a believer in the rally. I thought there was going to be a lot of fallout. I thought the virus was going to be a lot worse than even happened with it. And I didn't see this huge rally coming. Like I said, the signals weren't quite there. It was still so volatile, and the implied volatility was high. The contango was still there. So it was a tough. There were some opportunities, as Chris says, but the old signals didn't come through as well as I would have hoped, Mark.
Yeah, you weren't alone, Matt, by any means in missing out on these signals, because the signals were mixed and sometimes insane. Let's fast forward here to June. June 30th is when we recorded our episode 6 of the year, so pretty much halfway through the year now. And, of course, Dow and S&P set to put in their best quarterly performance in over 20 years. At that point, NASDAQ was having its best quarter since the dot-com crash back in 2001. So pretty much all of the sell-off in March had been erased. And then some, of course. Late May into June was also when we saw the beginning of the civil unrest here in the U.S. I believe when we recorded this episode, I actually had National Guard armed on my door, a Humvee outside the studio, and machine guns and all the rest. It was an interesting time. So putting the markets in that kind of light, we had an interesting filter here in downtown Chicago. The city was literally burning in parts while all these record markets were going on. It was an odd bit of cognitive dissonance to be in the middle of, and one I'm not sure I've truly still processed in my brain here 6+ months later. It's a little bit different thing when you're on the business end of seeing all this madness unfold just a block or two away from where I'm standing right now. Of course, the markets were starting to come back in a physical form as well. SIBO had announced plans to reopen their trading floor, bring back SPX and everything on June 8th. That got delayed a little bit due to the aforementioned civil unrest. Hard to bring people back when the city was burning, but by the end of the month, they did manage to bring back SPX in some form. This was the first time we really started seeing a lot of the analysis of and the noticing of what we've called throughout the rest of the year the Robinhood trader, the one-lot trader. This was the first time we saw big analysis of that. The Journal doing a big write-up called Free Trades, Jackpot Dreams, Lure Small Investors to Options. So this was we had seen it earlier, but this was the first time people started devoting a lot of analysis really to it. And Matt, of course, did his infamous analysis of the implied volatility surface as well. And of course, that wasn't enough for the month that was June. We also saw the death of TVIX, Credit Suisse deciding they're getting the heck out of Dodge and closing down the much beloved / maligned TVIX. And that wasn't enough out there in the advisor space. The Schwab TD merger won shareholder approval, a big deal for a lot of advisors out there, since a lot of them are domiciled with Schwab, and even more of them now as a result of that merger. Let's go back around the horn again. Let's start this time with Mr. Matt. Sir, a lot going on. SPX coming back We had madness still afoot. The market's putting in their best quarters. Most of the country in flames in the major cities. And T-Bix going the way of the dodo. And you're analyzing the vol surface. A lot to unpack there, sir. What was lighting up your tape back in June?
Well, in June, we saw that, another big drop. The bottom fell out of the market for a few days there, starting at the 11th of June and a couple days hence. That was a very fast and violent move in the volatility. And, it reminded people that, this could happen again. We saw massive volumes. People don't remember, but those volumes were huge, like bigger than even during March. So that, that got people kind of freaked out. And yeah, as you mentioned too, that's when we started looking at the skew a bit, and the way out of the money calls, aka the favorites of the Robinhooders. That's when they just started to move up that measurement that we take. We look at the 5 delta versus let's just say the 75 delta. So the way out of the money versus the put. That started to kick up not until a couple months, and we'll talk about that when that really kicked in. But the volatility is still high in June. People are still skittish, and you're going to go sideways most of June before you get the next leg up, Mark.
A lot to unpack there. Mr. Director of Risk, of course, coming into this episode, things were still elevated. VIX was still back north of 30, so our audience who had been fading the drop below 30, they were right, at least for the next episode, 30.5 on this one. Mr. Director of Risk, what was going on out there in Swanland, and what are your thoughts on, as Matt just mentioned, kind of the rise of the one-lot trader, certainly one of the dominant themes for the options market of 2020, sir?
Yeah, June was definitely a volatile month. I think a lot of people were making the call that was it. That was the high. That was the end of that rally that we talked about earlier in the show. But the one lot trader has changed the marketplace. I mean, 1987 introduced the concept of skew. The great financial crisis started to do things to the term structure. And now you've got another element into the marketplace. And then this is what happens as market dynamics change. Don't forget, all the listeners need to always remember, and I've always said that supply or volatility is based on two things, supply and demand. And if that supply and demand changes, then volatility is going to change. Skew is going to change, the term structure is going to change, and just basic option pricing is going to change. So that's something that is part of this game, and something that we've got to be cognizant about, and something that we need to watch. And it's great to have all these services out there and Matt out there crunching this great data, because we can pick this up rather quickly now. We don't have to sit around and is it real? Is it not real? Well, it was very real. I mean, you're setting option volume records, and this was nothing to. I think people at first were discounting the Robinhooders, like, well, they're not really making an impact, and the reality is they are making an impact. I mean, I guess how much is debatable, but they're there and it's real, and the data shows that.
All right, we've been talking for a while here. We've barely scratched the surface on this year. So I may have to start combining a couple of these months together so we can make sure we squeeze in some of the listeners. I promised them they'd be on the show as well. We can't go out without some mail call palooza / that's the wrong show. Office hours palooza here as well. So our July episode from July 29th, that got moved to August 5th due to one of the legion of hurricanes that was besetting Puerto Rico at the time. Coming into that episode, VIX was at about a 23. We also had the numbers finally for June, and June was the busiest month in options history at the time, up 81%, 693 million contracts. So blowing away even the March level. We also talked on that show the early assignment tragedy coming out of Robinhood, this wave of one-lot traders who don't really understand options fully. That was the tragic consequences of that. That customer committed suicide over what was effectively a faulty debit in his account of $700,000 on an early exercise of a put. We also discussed at the time, we kind of kicked off our saga about the Series 7. Someone asked us a question about that, and it led to a bunch of back and forth with our listeners about how much utility, or probably more accurately, the lack thereof, that the Series 7 has from an options perspective. Spoiler alert, a lot of you guys were not exactly charitable on the utility of the Series 7 for an options use case. Later that month, we had our episode 8, 23 1/4 where VIX was. Speaking of VIX, SIBO launched the mini VIX futures. on August 9th, kind of to a bit of a whimper. They haven't really been a game changer that a lot of people thought they were going to be. Also, at that time, speaking of volatility, CME and NASDAQ announced the impending launch of Vol-Q, so the at-the-money vol of the NASDAQ 100, changing a bit of the volatility landscape yet again. NASDAQ, a very volatile index. Makes sense to have a product on it. You've been hearing a lot about it on our Option Block show this year. This is also where Chris kicked off his feud with the Thompson twins over his use of his mullet trading strategy and for the VIX futures term structure, something which the Thompson twin folks had coined themselves. And so they fought back against Mr. Director of Risk on that show. And let's fast forward also to September as well, episode 9. VIX was still frothy, 26.30. We talked about the VIX futures term structure. All eyes then were on the election at that point and how it was being priced in. And it looked like they were pricing in a fair amount of juice. And August numbers were in for the year, and of that month, actually, a pretty active month, but not the June level, 615 million contracts on the tape that month. And also, that was the episode where, since in between then, the Fed had come in and really changed the game from an overall perspective. What they termed average inflation targeting, doing away with that, which has been, a lot of people thought, kind of one of the goals, the raison d'etres of the Fed was to keep inflation in check. And the Fed kind of saying, yeah, not so much to that. So that really changing the game for a lot of folks out there. Let's see. Let's just do a couple more here. I'll just throw them all in here, and then we'll go around the horn for some final thoughts before we get into the question. Episode 10, October 27th. VIX still frothy, 33 1/3. Also talking then about how the markets were pricing in the election, looking at the VIX futures term structure a lot on that show, showing they were pricing in still a fair amount of juice, about 5 points premium to the cash on that no future in VIX. So kind of juicy still out there, even though getting into the election, it was starting to come in a little bit. I also talked about how JP Morgan kind of sided with us saying, hey, that 60-40 portfolio, that's done. That's gone. You got to consider alts and other things now, something we've been championing on this show pretty much since the beginning. And we talked in our Options 101 on that episode about hedging some event risk. Probably makes sense heading into a big event, talking about puts, put spreads, ratio put spreads, and collars. Episode 11 coming into this show. So that was last month, November 18th. 2384 was where VIX was. We looked at the advisor industry overall in 2020. A lot of people thought it would be a terrible year, but as we talked about it, actually saw a net increase of about 4% in registered advisors over the year before. Matt did his interesting analysis of Russell 2000 bucking the trend, call buyers pushing small caps aggressively higher. And on that episode, we talked about stock substitution. So a lot to talk about there as well. Let's go around the horn again. Let's start with the Director of Risk, sir. Let's encapsulate the second half of the year that I kind of just broke down a lot. But all the evolutions we saw in volatility, in the VIX futures, how they were pricing volatility going into the election, coming out of the election. Of course, your much ballyhooed battle over the VIX mullet. And everything else, the Fed changing their views on inflation, everything else that lit up our latter half of the year, sir.
You just did a great job summing it all up. I am going to go back to that term structure, the election day hump, because I don't think you're going to see a term structure for that for a very, very long time. It's set up for a very nice term structure butterfly trade that paid off nicely. And also those of you that faded that volatility for right after the election, or actually started coming in right before the election, that was another good trade for 2020.
It was indeed. Mr. Matt, same question for you, sir. A lot to encapsulate here. Extensive rally, vol around the election. 60-40 portfolio is dead. The Fed doesn't care about inflation anymore. A lot to unpack there, sir.
Yeah, this is when the small traders made their mark. What we were seeing was some immense skew changes. And Chris brought up a great point earlier. Volatility is based on supply and demand. And we heard things about dealer gamma. And, what we started to see was dealers having a huge demand put on these way out of the money calls. And so when the stocks would start to go up, the dealers would have to buy the underlying stock because their gamma was getting them shorter deltas. And then when the stock, so it made it much more volatile going up through the strikes. And then when it came back down the other way, they're still short that strike. The strike might be underneath where the stock is now, and now they're short the strikes underneath, and it made it even more volatile going back down through. So that's what we saw. We started to hear about, dealer gamma and people, including us, trying to identify where the dealers are short. And the way that we were doing it is looking at the term structure. And like I said, especially these way out of the money calls, we're getting so highly priced. We had never seen these levels before. So that was the big things that I took about from this, Mark.
All right, and it's time for us to take some of your questions. I promised you guys would be on it. We didn't have a chance even to touch on Matt's earnings volatility breakdown for the year. There's so much to do. We could do a whole show just on that. Maybe we will. Maybe I'll drag Matt back on the mic sometime this week just to do a separate little mini episode about all the madness and drama that was earnings volatility. I guess we can encapsulate it right now. Don't buy it. That was the story for this year. If you sold it, you worked out all right. But now it is time to get to some of your queries, a special holiday palooza of the office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, let's do it. Since it's such a mad year, let's kick it off with some love. This love comes from Andre G. Oh, maybe Andre the Giant. Maybe he wrote to us in his love of the show from beyond the grave here. Andre G. saying, thank you for producing this fine program. It has opened my eyes to the opportunities available in my practice with options. There truly is nothing else like it. Have a happy new year. Well, thank you very much, Andre, and everyone else who sent in similar sentiments throughout this year. You guys are a very unique audience out there for the financial advisors and asset managers who are learning how to use these products. And this was a year, pretty much, if this year didn't teach you about the value of using them, I'm not sure what would. But a crazy year. We heard from a lot of people like you, Andre, and you guys are the reason this show exists. So you're welcome to all of you out there. Then we have a different comment here from Charlie T saying he's not really an options guy. I don't need the headache of yet another unknown element, aka time. It's hard enough just picking my stocks, deciding price points, exit points, etc. I hear you, but hopefully if you listen into a show like this, Charlie, you've learned that some of that extra headache, as you call it, is worthwhile. You get leverage, you get the Greeks working for you in most situations out there. And if you're buying and selling stocks with limit orders, very least you should be using options to do that. Get paid to do that. At the very least, get rewarded for some of that risk you're taking. We've all learned this year, limit orders are risk. Posting an order somewhere in an order book is risk. You could get hit on that and blown through it in many different ways. You're not getting compensated on the equity side. So at the very least, Charlie T and everyone else who maybe is a little bit intimidated still by these products, at the very least, you should be using options to get into and out of your clients' equity positions. It's a very basic use case, and it makes a heck of a lot of sense. Here's an interesting one. This comes from Jack K. Jack K wants to know, do I really need to worry about diversification in my portfolio when I can use options to hedge whatever risks I want? You know, Matt, I've been making this claim pretty much since this show started a long time ago. Back when it was like, I think it was me and Alan from OIC out there, that as JP Morgan awoke to it finally this year, 60-40 is dead. But that old diversification model is antiquated. Throw it out the window. At the end of the day, we saw this year, the only real reliable inverse correlation / hedge you can count on is buying an option on something, buying a put. You know exactly what you're going to get. That's in the contract. Everything else is hearsay. And we all saw in the madness of March and other days, correlation tends to go to one, often in the wrong direction. So, Matt, we had to say for Jack K, who says, why do I need to worry about these old school 60-40 allocations? I can just use options for hedges, sir.
I like where he's going with it. But, like I say, puts should be their own asset class, because really everything else, people are selling in order to cover margin calls, and puts are the only thing that's guaranteed to go up. So, but another thing where I might just want to point out something, you're seeing some disconnect between IWM and SPY. You're seeing disconnect in the volatility skews. You're seeing disconnect in especially like the NDX with it heavily favoring just a few stocks. So, I think diversification within the market, I think, is healthy. You have to look at what your real risk is and what your real position is, and you can alleviate some risks that options can't do on their own. So if you for example, if you were short calls in IWM components, you're not going to be doing very well. But if you were short calls in SPY or NDX components, those perform better via skew. So there is still some argument to diversification, even with options, Mark.
I like that. You made that call before on the show. Puts should be their own asset class. I can get behind that. Mr. Director of Risk, hey, what are your thoughts on this? Puts should be their own asset class, and then be what you say for Jack K. No, he's kind of beating the drum. You guys at SWAN have been beaten for a while. Old school diversification is dead, and options should be the new focus out there for folks looking to hedge and diversify, sir.
Yeah, so that goes back to that 60-40 conundrum. And, the reason you diversify portfolio or you seek diversification is because you want some type of protection when an event happens, when there is a bear market, right? You want that diversification through full market cycles. Unfortunately, what the great financial crisis taught us is that, during times of stress, everything correlates towards one. So you don't get that diversification that you once did. Again, this is part of a changing marketplace that we're all involved in. So yeah, the only really thing that is going to work when markets go down are puts, right? For the most part, unlike trying to diversify, stock versus stock, being long stock versus short stock. That being said, though, what Matt just brought up, 2020 was kind of a good year and I see the shift here in relative value trades, meaning you saw a lot more people being, long vol in one index or skew versus being short vol or skew in another index. And I think that is what has set up nicely in 2020. It kind of goes back to what I said earlier. It was like, I was kind of telling some of the other, younger guys at the firm, I was like, there's actually some things that I'm seeing that I haven't seen in a few years. Relative value trades, this is happening here, this is happening there. The term structure is lining up differently. So it was a good trading year from that perspective because we had these dislocations. But to answer the question, yeah, puts are going to protect you. They're going to protect your portfolio if markets go down.
You need to call up the SIBO, Matt, get to work on that. Puts, forget VIX as its asset class and volatility as an asset class. Puts should be their own asset class. All right. We got some specific questions, so we'll wind down with these. First off, this one's for you, Mr. Director of Risk. It comes from NXT. He or she wants to know, what was the impact of the sell-off on the hedge strategy of SWAN, and was it difficult to manage the strategy during the tumultuous sell-off in March and then the rally in April? We kind of touched on this earlier on the show, Mr. Chris, during our summaries of the March and April time periods here, but maybe break it down a little bit for Annex and everyone else in our audience, the mindset and what were some of the challenges for you as the Director of Risk during these months where there was nothing but risk on the table, sir?
So the hedged equity component did what it was supposed to do when the markets went down. Okay, the markets are going down, you're invested in equity, the hedge is working. That's the good part. You get to sit back and enjoy and watch that. And the challenge there is, if you're not familiar with the defined risk strategy, we have this annual rehedge, which characteristically occurs towards the end of the year, or if there's a large market move. So we did rehedge our portfolio in March, not necessarily right at the low. We're not in the business of picking lows or highs, but somewhere near that, and we were satisfied with that rehedge call. With the more challenging piece of the component, if you're familiar with the defined risk strategy, is that we sell income or we sell options to try to fund the cost of that hedge. So, and I won't lie, during this type of sell-off, 2020 is going to go down as the sixth most volatile year ever. So it's in good company with the Great Depression, the dot-com bust, and the GFC. So, selling volatility during second half of February and March was very challenging across the board. But with our risk management and the rules and adhering to our rules and having a defined, disciplined, and repeatable process, we're able to pull those trades and sit on the sideline during these periods and then focus more on the hedged equity portion. So the hedged equity worked great, but there's challenges with selling income in this kind of environment as well. So you have to manage those two components. But again, we've been managing the defined risk strategy has been around since 1997. So this isn't the first rodeo, if you will. We've been around for the dot-com, been around for the GFC, and now we're around for 2020, whatever this year. I don't know what this year is going to end up being called just quite yet, but whatever it is, we're still here.
we've termed it the dumpster fire. It seems to be sticking. So
that's perfect.
We'll go with that. We're going long here, but we love you folks, so we're going to squeeze some more of you on here. This one's for you, Mr. Matt. This comes from Melsink. Melsink wants to know, I enjoyed the Russell 2000 call analysis by ORATS. Are there any other indexes or stocks that exhibit something similar right now? Matt, you were talking very recently on this program and on our TriFi program as well about these crazy 5 delta calls out there in the Russell 2000, how you were seeing skew setups that you hadn't really seen before out there. So what do you have to say for Melsink wants to know, you see anything else out there even close?
Yes, actually, I was just reviewing some of my notes and looking at our chart package at wheel.orats.com, and the calls are going up. I even look at energy, and energy calls are a lot higher than you'd expect. IWM, of course, is leading the pack right now, but even the financials, XLF, and then XLK, those skews are high. So to answer his question, yeah, you could look at virtually any ETF right now, and what we do at ORATS is you type in the ETF and then you type in _C to get the component weighted skew. So we average all the skews by the amount held by the ETF, the percentage held, and you could see these numbers, and you can't believe it. I mean, Chris said earlier that 1987 brought the skew. Well, 2020 turned the skew on its head. You know, the calls are now skewed as high as the puts in many cases, Mark.
Well, that music means we're coming up against it here. We're beyond it now at this point. But again, we love you folks. So we're gonna end it with this question here from Leds77, maybe a Led Zeppelin fan out there. As appropriate a question as you could end on as any for this year. He or she wants to know, what are your big takeaways from 2020? Well, he actually puts 2002, so many, many years in the future, but we'll go with 2020 instead. Let's go around the horn. We'll start with the director of risk. We talked about a lot of mad things on this episode. Chris, what would you say is your major takeaway from this year of madness that was 2020, sir?
Markets are always changing. They're always in flux. So always stay invested and always stay hedged.
Look at you on message, sir. Well done. All right, Mr. Matt, are you going to be equally succinct, equally pithy for your takeaway, your big takeaway from this dumpster fire of a year, sir?
Well, one of my favorite Zepp songs is "Nobody's Fault But Mine." So, I think what that says is, trust yourself, trust your triggers, do your back testing, stick with your program. Is a great thing to do what we're doing now. Go back over your trades, look at the year, look at each month. That's what you want to do. And I'm not going to sing for you, Mark.
Did you dance in a Led Zeppelin video too? Do we have to go find that as well?
No, I told you. I told you the movie that you should be looking at, Side Out. You could get some good pictures in there.
That's next up for our crack research crew. I still have to mull this over. We're probably going to do some more episodes wrapping up the year here. But for me, I think one of the big takeaways for this year, we kind of touched on it earlier in the show, is just the explosion, the tsunami of the retail, call them whatever, Robinhood, One Lot, whatever you want to call them, the retail explosion that was 2020. Chris said it earlier in the episode, they have changed the shape of the options market. They have changed the game in many ways. They certainly have changed our audience in many ways, as the influx has been just ridiculous across the board, which we love. We love all of the new folks joining us out there. Keep those questions and comments coming. We'd love to hear from you guys. But that, to me, has been just the most demonstrable, I think, change, and one that I think will linger beyond 2020. I don't think these people are going to go away. Inevitably, the market will turn. Some of them will blow out from doing all their crazy upside Tesla and Apple call buying. That's not a long-term road to profitability. We all know that. So some of them may go away, but I think a large percentage of them will stay around and keep using their options things, and as a result, they'll drive more advisors into the space through client demand, and it should be a good thing for everyone in the long term. All right. Unfortunately, that's all the time we have on this super extended, extra jam-packed edition of the Advisor's Option, looking back on this crazy year that was 2020. Before we go, though, let's go back around the horn. Let's start with the Director of Risk. Sir, you guys have some cool new stuff coming in the land of SWAN. So if folks don't want to play in the mutual fund game anymore, you got something cooking for them in the hedged ETF realm. Break us down a little bit more for us and tell folks where they can learn more, sir.
Yeah, we sure do. So in addition to launching our own ETF, HEGD, we also partnered up with Pacer ETFs and launched 3 structured outcome strategies. So we have a conservative, a moderate, and what we call a flex or a flexible buffer. So they provide protection depending upon which ETF you select. They provide a structured outcome with markets down 15, 20, and 30%. So you can learn more information at swanglobalinvestments.com or paceretfs.com.
PacerETFs.com. There you go. Check it out. Swan Global Investments, of course, the place to go in between episodes for all the great content over there and a whole bunch more. And Mr. Matt, if folks have questions about earnings, vol, or about skew and small cap, sounds like they have all of the above and much more. Where should they go? What should they do, sir?
I thought we were busy, but congratulations to Swan. They've been really busy and some great stuff, so that's awesome. But Mark, the 2021 is going to be great for ORATs. We have a paper trading functionality, so people could back test and then implement strategies and see how they've done. We've got a great new scanner, great trading from our chain. We're able to now trade from our platform, and we've got some really great consulting templates, so we can run a bunch of back tests and forward tests and out of sample, and then we're doing a lot of work with these triggers that I talked about on identifying the best triggers to get in and get out. We're applying them not only to the stock movement, but to when to get in and get out of option positions. Like here are the best triggers for an iron condor. Here are the best for a long call. So 2021 is going to be great. Congratulations to Swan, and looking forward to a maybe not as eventful next year, Mark.
I think we could all use a little bit of a break. Everyone always wants more volume, more volume. We've seen what it takes to drive that volume. I think we can all use maybe a little bit of a break from that. Check them out over there, orats.com, the place to go, ORATS, or give them a follow on the old Twitters at OptionRats, a very memorable handle. Of course, while you're checking things out, check out our friends over there at the OIC. Optionseducation.org is the place to go. Check out all their educational content and a whole bunch more. They have a whole advisors tab over there, so click on that if you're interested. And on behalf of our friends over there at OIC and Matt and everybody over there at ORATS Land, and of course Chris and everybody over there at Swan, and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, for making this year of 2020 certainly a memorable one and a great one here for the Advisors Option. We really do appreciate all of you taking the time to listen, to download, to stream, to send in your questions and your comments. We appreciate and thank every single one of you. And we'll see you back here in the new year with another episode of the Advisors Option.
You've been listening to The Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by SWAN Global Investments. Since 1997, SWAN has been the leader in hedged equity and option income strategies with GIPS verified results. SWAN provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, SWAN defined risk mutual funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think SWAN when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.